So here's a question. What can be done? Here's the nuts and bolts. Over the next couple of slides, we're going to go through in a bit more detail some of the key things that you can do before 30 June this year to help reduce your tax bill coming into year end. And I said, and then after that, we'll touch on a couple of examples. All right, so what can be done? Let's start with companies. I've sort of set this out in sort of two areas. One's about expenses and one's about the structure, but they also cross over a bit too. But let's just talk through some of these at a high level. And as I said, we will send out an accompanying document that sort of adds more color to some of these. So don't panic if you sort of miss what I'm saying through here. We will send out some more information on this. But some are reminders and some are things you can do. First one, superannuation contributions. In order for that to be tax deductible this financial year, the superannuation you pay on your employee's salary has got to reach the superannuation fund by 30 June. Okay, 30 June this year is a Monday. That means you have to have paid probably your superannuation payments, if you go back a few days, by the 24th or 25th at the absolute latest, preferably earlier. Okay, it takes time because your superannuation payments go from your company, to the super clearinghouse, and from the super clearinghouse, it goes to the funds. Okay, and so if you do this Saturday afternoon on the 28th, or even Friday afternoon on the 27th, it won't reach the fund by the 30th. Okay, so that's the rule. You've got to make it sure that the superannuation payment reaches the fund by the 30th. Next one down there, instant asset write-off. Okay, so we've already spoken about $20,000 again this year. There is a nasty consequence to this, and I'm going to touch on this in a slide or so. But just be aware that, actually, sorry, it's on the right-hand side there, the sale of fixed assets. So those two things are joined. And I want you to think for a second. I bought shelving for my office, for example. Let's say I bought $5,000 worth of furniture for my office. Okay, I got a $5,000 tax deduction for the desks. That's great. After a year or 2 or 3 years, I sell the furniture. Okay, we move office, I sell the furniture, I get $1,000. For the $5,000, I get a tax deduction in that year I purchased it. Okay, that's great. That's the instant asset write-off. However, when I go to sell it, what it means is I've now got $1,000 gain because the tax cost is zero. Okay, now this is something to watch out for, and the Treasury's known about this because they put it in budget papers, but it's been a bit of a hidden issue. And it's only now really starting to come to the fore as businesses who had large instant asset write-offs during COVID are now finding themselves having to pay tax on asset sales. So if you do sell fixed assets, just be aware, and this includes motor vehicles, for example, too, right? If you've got a motor vehicle where you've had instant asset write-off and you trade it in, there can be a potentially nasty tax consequence selling that. And so, just be aware that if you're selling fixed assets, that you may end up paying tax on the gains you've got, right? It doesn't work out in terms of tax ins and outs, but it's a timing issue. Bucket company strategy, I've got an example of this. We'll come back to this, but this is something you can think about in order to help manage your cash flows. And it's a fairly simple tax strategy, but does help lower tax burdens. Okay, inventory valuations. If you're the sort of business that has inventory, you've got choices about how you value your inventory. And so cost of net realizable value. And what this means is that you can pick and choose. And so there might be better tax consequences picking one over the other. Also, don't forget, you need to have a stock take done at year end, at 30 June. So if you've got over $5,000 in stock, you need to actually count it up, mark it off, and keep records. That's an important piece to remember. Prepayments. And sorry, let me take a step back here for a second. A lot of what I'm talking about here are for small business entities. Okay, the tax law defines a small business entity with turnover of less than $10 million. Okay, so we're talking about businesses with turnover here less than 10, which is the bulk of our client base and the bulk of you listening today. If you're bigger than that, some of these won't apply to you, or different rules will apply. The other thing to remember too is different size businesses have different tax rates. So if your turnover is less than $50 million, you're termed a base rate entity. and you pay 25 cents in the dollar tax. If you're above that, you're not a base rate entity, you pay 30 cents in the dollar. Okay, so again, just understanding where you sit uh, within those parameters is going to be important. Okay, sorry, back to that though, prepayments. So you can claim a tax deduction for prepayments you make. And here's an example, insurance. Insurance is a great example. If I prepay my insurance, let's say it's $4,000 for a year, I get a tax deduction in the year that I pay it for the full amount. If I'm a big business, I spread that over 12 months. Okay, so making sure you've prepaid things like insurance, interests, subscriptions, your annual subscriptions, all software subscriptions. If you prepay those before 30 June, you'll get a tax deduction for it this financial year, and that'll bring down your expenses in the current year. Bad debts. Again, make sure you look at late June, go down your list of debtors. Are there any on there that aren't likely to pay? And so if there is, then make sure you write them off. And what does that mean? Well, writing them off means you note down, formally write off that debt as unrecoverable, and therefore you get a tax deduction for it. Without doing that, you don't get your tax deduction. Repairs and maintenance, again, making sure that something is a repair, as in, am I fixing a hole in a roof or am I actually replacing a roof? And understanding the difference between the two of those. If I fix a hole in a roof, then that's a repair, that's expense in the current year. If I replace the roof, then that's a capital piece and I don't get a tax, I get a capital deduction over, it could be 10, 20, 30 years. All right, so understanding where you sit with those two. All right, talking about structures for a second. Company tax structures, again, it's a good time of year to think about your business. If you're a sole trader at the moment, there might be an opportunity where it might pay you to change to a different structure. Maybe a company structure in the future is a better way of doing things. If you own a business, perhaps owning it through a trust structure might be a better idea. And this is a good time to think about this sort of things. Div 7A loans, I'll come back to in a second. Remember vehicle logbooks. If you've got vehicles in your business or you use it for work, keep a logbook. Okay, you have to keep it for 12 weeks. It is obviously slightly painful to record one, but once you've got it, you can keep it for 5 years, as long as the pattern of use doesn't change. But what it does mean is you'll get a bigger tax deduction. And so it's important that you put the effort in up front to get that bigger tax deduction. Don't forget, there's a couple of don't forgets here now. Trust resolutions. If you've got a family trust or you've got any trust, you must resolve before 30 June and in accordance with your trust deed how to distribute that income. All right. In the bad old days when I first started accounting, a lot of the stuff was done. The trust distributions were done in August, September, October. Later on, that's a no. The ATO and the courts don't like that. It's obviously not keeping with the law anyway. And so make sure you document your trust resolutions in accordance with the trust deed before 30 June. That's a critical one. Dividends, same with dividends. If you want to declare a dividend by 30 June, declare the dividend by 30 June. Okay. Again, it's not something you can backdate. You've got to make sure the paperwork's in place and have it done properly and documented properly. Franking credits is part of that too. Don't forget, franking credits is tax paid money. It's money that your business has paid tax on already. Therefore, that's got a lot of value to you because you can use those franking credits. And we've got an example a bit later on showing that. But you can use these franking credits. They're fantastic tax planning tools. And for some businesses, I've seen businesses with millions of dollars of franking credits sitting there. It's like, well, extract that value, right? Because it's worth something to you. The other thing I'm going to touch on quickly here is just trusts and Section 100A. This changed a couple of years ago. It didn't change, I should say. The law has been there since the 70s. It was reinvigorated, perhaps. And this is a structuring question where if a trust distributes to, say, adult children, okay, does the cash flow to that child, for example, it deals with a thing called reimbursement arrangements. And it's an important tax risk that you've got to manage because you don't want to fall foul of it because the consequences can be quite nasty. So just as you're going through this part, perhaps give us a call, talk to your lawyers. But trust resolutions and things I've done over year end are an important area to get right. That's it for business.